afternoon. Happy Friday. This is Sean LaBelle of the Dekker Hewett Group. Welcome back to the Market Watch Weekly. Apologies, we'd been off there for a few weeks, but we are back into the full swing of things. And so was the market, it would seem, here with the S&P 500 now up for a fifth consecutive week. The rally's actually been quite extreme. It's up north of 13% here so far in July and August. You got to go back to 1932 before you saw gains similar to that. Back then, the S&P 500 was up over 90% in that time frame, so we don't expect anything similar to that. But nonetheless, a little bit of a reason for investors to celebrate. The losses that we've witnessed so far this year have really been pared back. Moving markets so far this summer has simply just been extreme investor pessimism, something that we've been discussing a lot in 2022. The broader climate just wasn't simply that bad to suggest, or rather to warrant, a 25 to 30% pullback in some of these major indices. The market had already been pricing in a recessionary environment, which simply does not exist at the moment. So as we're coming to see a little bit of the economic data, inflation starting to roll over in an earnings season that simply wasn't as bad as expected, those pessimistic expectations have really been reined in a little bit. A lot of the market rally has been short covering as well. Because of the excessive pessimism, there was also a historic short bet on the market. This has actually been now the third biggest short covering event in the last 30 years. So we discussed that a little bit in this week's Market Watch Weekly, but more importantly, it's just the ongoing conversation around inflation. Of course, that US CPI data last week was a bit of a reason to celebrate, but it still means there's a lot of work ahead of us. More importantly, a lot of work ahead of the US Federal Reserve. So the inflation numbers came down from the 9% peak that we saw in June. They're now with a 7.5% handle. But what this simply means is that the Federal Reserve can maybe be a little bit less hawkish in the forward commentary or the forward path of rate hikes. You're starting to see that now in the dot plots, with expectations now coming down from a 75 basis point rate hike at the next meeting down to 50. So this is just what we mean by the Federal Reserve can become a little bit more dovish in terms of the rate hikes. But it's important for investors to remember that there still is a lot of work ahead. They want to get inflation down to that 2% handle. So 7.5, while isn't 9%, is still very high. So do expect a lot of commentary around inflation and the continued path towards higher rate hikes into the balance of the year. But nonetheless, just a good reason for investors to take a little bit of optimism in here in the market. The backdrop is simply getting a little bit less hawkish. Hope everyone enjoys the weekend, and we will talk to you again next week. Cheers.